In this lecture, we're going to go through an example of an option contract used in a cash flow hedge. So let's start by talking about the facts in the example. Abbott Corporation plans to sell units of inventory with a cost of $122,000 to Costello Co., an Italian customer, on November 20th, year one, with an anticipated sales price of $180,000. An important thing to note here is this is a forecasted sale, so it's not a sure thing. They don't have a contract signed. They just expect that the sale is going to happen. That's why we've got to use a cash flow hedge for this, because it's not a firm commitment. There's no receivable on the books. We can't use a fair value hedge. We've got to use a cash flow hedge instead. To protect themselves against risk arising from this forecasted sale, on September 1st, year one, Abbott decides to purchase an option contract to sell 180,000 euros on any date before November 20th, year one, at a rate of 95 cents per euro. The option premium to purchase this option on this date on September 1st is $3,600. Then we've got some information about spot rates on the date that they enter into this option contract, September 1st, also at the end of the third quarter, September 30th, and then on the date of the actual sale on November 20th. We also have some information about the value of the option. Forward contracts are more straightforward to find the fair value of because it's solely based on the differences between the forward rates at whatever dates you're looking at. Options are a little more complicated, and so we use a really sophisticated model, usually the Black-Scholes model, to value options. And so for the purposes of this class, that option value will just be given to you. In reality, someone would have to put a bunch of data into this model, and then the model would spit out this value. So the option value under the Black-Scholes model is $6,200 on September 30th of year one and $9,000 on November 20th of year one. So on the next table, we see fair value calculations for the forecasted sale itself on each of the dates on September 1st, September 30th, and November 20th. And I've kind of written out here how you would calculate the fair value of the transaction. You're going to take the sales price, which is $180,000, and you're going to multiply by the spot rate on that date. And you'll do that for each of these periods. So that's at September 30th, and then on the date of the sale that it actually happens, we've got 180,000 euros, and then we take the spot rate here from cell B13 to get the fair value of the transaction. Another thing that we're going to need to consider going forward is the change in the fair value over time. We don't have to worry about this on September 1st here in cell E11, so the first time we really need to calculate the change is on September 30th in cell E12. So I'll look at how the sale transaction value changed over time. It went from 171 down to 165, so we've got a loss there. And then it went from 162 to 165, so it's dropped by an additional 3,600 there. Now we're going to do the same thing to figure out the value of our derivatives. The reason we're calculating these values is because these are the numbers we're going to need for the journal entries that we're going to record related to this forecasted transaction and the option contract. We just did it for the forecasted sale. Now let's do it for the derivative. Now the derivative, there's a couple of different values that we're going to need to calculate. We're going to, number one, need to figure out the overall fair value of the option. Now, the fair value of the option at the time of the purchase is whatever you paid for it. That's the fair value. And we know from our facts given above that the option premium, the amount they had to pay on September 1st, was $3,600. So here in cell D17, I'm going to type in $3,600. Then, at the bottom of the blurb at the top, it says, using the Black-Scholes model, the option is valued at $6,200 on September 30th and $9,000 on 11/20. And then we can find the change in fair value again, just like we did on the previous chart. Start with our fair value as of 9/30 and subtract the value as of 9/1. So here in cell E18, we see that our value has gone up in value by $6,200 during the period. And then we do that process again on 11/20. We take the fair value on that date, subtract it from the last time we measured it, which was September 30th, and we've got another increase in fair value. Notice that, as we would expect and hope, our sale transaction fair value went down, but our derivative fair value went up, and that's the purpose of hedging. Now, with cash flow hedges and with option contracts, we've got to consider not only the change in the overall fair value of the contract, but also the portion of that change that comes from intrinsic value, which is basically just changes in the spot rate over time. What makes this intrinsically valuable is that the spot rates would go up or down and might hurt or help us. So that's the intrinsic value. But the other thing to consider with an option contract is the other value, which is basically the time value of money. An option becomes, the value changes over time based on the time value of money. A few months out, an option has a lot of time value because there's a lot of things could happen between, September 1st and November 20th. But as November 20th gets closer and closer, that time value decreases over time because not as much can change or happen in that time period. So when we calculate the intrinsic value of an option, that's going to be based on the spot rate. So at the change in the spot rate. So at September 1st, what's interesting is that the option, we've bought it on this date and the intrinsic value hasn't changed because we're measuring it as of 9/1. So there's no change as of 9/1 to the value based on the spot rate at 9/1. So our intrinsic value of the option at the beginning is 0. However, 1 month passes, the spot rate changes from 95 to 92, and so our intrinsic value changes as well. So to calculate that, we're going to take a look at the change in the spot rate, which it's gone down. So we're going to take cell B18, 92 cents, minus 95 cents in B17, and we're going to multiply that by our transaction currency amount, 180,000 euros. And that's going to give us an intrinsic value that's gone down of 5,400. And then we're going to, or it's gone up, but the value of the option has gone up, but the spot rate has gone down. So that's why that's negative there. And then we'll do the same thing as of November 20th. So we're going to take the 90-cent rate and given here in cell B19 and the 92-cent rate in B18, and we'll multiply that by 180,000 units, and we've got a $3,600 negative value there. Now let's calculate the change in the intrinsic value as of September 30th. This is going to be based on the difference between the spot rate on September 30th to the spot rate on September 1st. So we're going to calculate the intrinsic value by looking at the difference between these two. The spot rate was at 92 cents here in B18, and this is a change from the 95-cent rate in B17. We'll multiply that by the number of units of currency that we're going to exchange, and we'll have an intrinsic value of negative 5,400 here. Then we'll do the same to find the intrinsic value as of 11/20. An important thing to note here is we're comparing this 90-cent rate given in cell B19 to the original rate of 95 cents to figure out our intrinsic value. So when we do that, we find a final intrinsic value of $9,000 of the option. And we'll see how that changes over time. It went from 0 to 5,400. So the difference is 5,400 here. Again, these numbers are negative solely because the spot rate is going down. It's just a function of a decrease in the spot rate. And that's why these are showing up as negative here. And then we're going to do the same thing when we look at the change in the intrinsic in cell, when we're calculating in cell G19, we're going to take the intrinsic value given in cell F19 and subtract from the last time that it was measured, which was on September 30th. And so we end up with a change in the intrinsic value of 3,600 on this date. Now, the other value is a function of time. So when we calculate the other value of the option, we're going to basically look at the overall option value. And so that option, the option fair value of 3,600, and we're going to subtract the intrinsic value. Here is 0. And that gives us the amount of the other value. So all of the value is other value at the beginning of this contract. We're going to do the same thing here. We're going to take our option fair value. I'm subtracting the difference, but because this is showing up as negative because of the function of our spot rate, I'm actually adding, which will effectively subtract the difference between these two. Now I'll do the same thing as of 11/20th. I'll take the option fair value of 9,000. I'll add to subtract the intrinsic value of 9,000, and I see that I have 0 of other value at the end of this transaction, which is what I would expect, because remember, the other value really comes down to the time value of this option, and on 11/20th this option has no time left, so it has no time value. So it should be 0. So then we look at the change in other value, just like we've done for the other types of value, the fair value and the intrinsic value, and now we're doing it for the other value. So we say it was 3,600, it went down to 800, so it decreased by 2,800. And then we do the same thing here. It was 800, it went down to 0, so it decreased by 800. And now we've kind of completed all of the calculations that we're going to need to do our journal entries. So the first thing we're going to do is the journal entries for the forecasted transaction itself. Now remember, this is a forecasted transaction that's not going to happen until 11/20. So on 9/1, there's no entry related to the transaction because it's a forecasted transaction. And same thing on September 30th. There's no entry because this is a forecasted transaction. We're not marking the transaction to market because it's not a firm commitment. It actually hasn't happened. There's nothing firm to mark to market at this point. So there's no entry related to the actual transaction on September 1st or September 30th. On 11/20 of year 1, something finally happens. We're going to be able to record the transaction. So we're going to record this like a normal sale. We're going to debit cash, we're going to credit sales, and we're going to do this for the amount that the sale actually occurs at, which is 180,000 euros, and we're going to calculate that at the spot rate as of 11/20th, which we can see over here is 90 cents in cell B13. So that's what our cash is going to be translated at in our journal entry. And just to kind of sum this up, or as a reminder, this is the spot rate times 180,000 euros. Then we've also got to record the cost of goods sold portion of the transaction. So we're going to debit COGS and credit inventory. And we're given, in our facts, we're told that the cost of the inventory, one of the first things we find out is that it's 122,000. So we're going to record that down here. And that's just given cost of inventory. Now we can start working on the journal entries for the hedge transaction. We're going to start back over as of September 1st. Now for the hedge transaction, we're really talking about the option contract here. And something did happen on September 1st related to the option contract. We bought it. So we're going to record the purchase of the option contract on this date. When you buy an option contract, you receive an option contract asset and you pay cash. So we're going to debit option contract asset, pay, and then we're going to credit cash for the cost of the contract, which was given as 3,600, and that's just given as the option contract price. Then, if we fast forward to September 30th, we're going to have to mark that option contract to its market value. So we're going to record the option at fair value. Now, if you look over at the calculations we did just a moment ago, we calculated that the option fair value based on the Black-Scholes output told us that it was 6,200, which is an increase in the fair value of the option contract of 2,600. So we are going to debit option contract, market to market, by increasing it by 2,600. So I'm going to set that equal to the change in the fair value of the option contract. And to summarize, that's the change in the option fair value. Then I'm going to record the components of that increase in the option contract asset, the intrinsic value and the other value. The intrinsic value is based on the change in the spot rate, and we see that the change in the intrinsic value was 5,400 as of 9/30th. Again, just as a reminder, this is showing up as negative because it's based on the change in the spot rates from 95 cents to 92 cents, but that's actually a good thing for us. The spot rate has gone down, but we're still locked in at our exercise price of 95 cents. So we're in good shape. And so that it's showing up as negative here because the spot rate went down, but actually it's a positive thing for us. So we're going to record that as a gain, and it's going to be recorded in OCI. So we're going to record the intrinsic value change of 5,400 in OCI. And the reason that we're recording it in OCI is because this is a cash flow hedge, and all derivative components have to be recognized or marked to market in OCI in a cash flow hedge. Now, one part, notice the change in the option contract fair value is 2,600. 5,400, we've got a 5,400 increase in the intrinsic value, but the reason that the overall is only 2,600 is because we also have something called the change in other value, which really relates to the time value of money. The closer we get to that option expiration date, the less value this option has from a time perspective, because less can happen, less can change. GAAP specifies that all changes in option contract asset that are related to the time value of money have to be recorded in sales in the period, have to be recorded in the related income statement item, I should say, in the period, which is sales for this because we're talking about a sales transaction. So what we're going to do for the change in other values, we're going to debit sales. And if we see here, the other value has changed by 2,800 as of September 30th. So we're going to debit sales 2,800 here. And lo and behold, our journal entry balances, and we're good to go. Now let's fast forward to 11/20th of year 1, and we're going to do the same thing. We're going to record the option at fair value. This is the transaction settlement date, but before we can settle the option, we've got to mark the option to fair value on our books. So we're going to do basically the exact same journal entry we did just a moment ago. We're going to debit the option contract asset for the overall change in the fair value, which we come over here, we see as of 11/20th, the change in the fair value is an increase of 2,800. We're going to debit sales for the change in the other value of the option, which we see over here on 11/20th, it's decreased by 800, so we're going to decrease sales by 800. And then we're going to record the change in the intrinsic value in OCI. And we see as of 11/20, our change in intrinsic value is 3,600. So I'm going to note that those are it's literally the same journal entry that we did just a moment ago. So I'm going to copy over my notes. Now we're going to record the settlement of the option. We're going to record the settlement of the option. So this involves the party that we entered into the option contract with us. They've got to pay up the difference between what we're going to receive from the customer, which is going to be able to be translated at 90 cents instead of 95 cents. The difference between that is the option offerer is going to have to pay us. So that happens to be the fair value of the option at the time that we are settling up. And that's always the case. So we're going to record cash for that settlement. We're getting the payment for that difference between the current spot rate and the option exercise price. And we're going to credit the option contract asset because now it's settled. And so that's going to come at the fair value of the option, which is 9,000. That's the fair value of the option at 11/20 of year 1. And if you'll notice, interestingly enough, it's also this option contract, we're crediting it at the total amount of our debits. If you take that $3,600 debit plus this $2,600 debit plus this $2,800 debit to the option contract, comes out to 9,000, and that's effectively what we're taking off the books when we settle the option contract. Now the last thing we have to do on this date is we have to reclassify the prior gains from OCI into net income. So we've got to take everything that we credited to OCI and move it to net income, specifically in the account used to record the forecasted transaction, which is sales. So we're going to debit OCI in an amount equal to all of our previous credits to OCI, which is 5,400 here from September 30th and 3,600 here in cell P, whatever that is, P30. Those are both going to be credited out of OCI and into net income via sales. And so to sum up, that is the credits to OCI on 9/30 and 11/20. And that completes the journal entries that we need to record the hedge transactions. Now that's a lot of journal entries, so one thing that I like to do to kind of bring it all together is to look at the overall effects on sales and on cash. So we're going to look at it by quarter and then in total. In Q2, which is basically anything that happened in September, we can see that nothing happened in September related to our forecasted transaction, but related to our hedge, we did record a debit to sales for that change in other value of $2,800. And that's a decrease to sales since it's a debit, so I'm going to put a negative sign here. We've got a negative effect on sales of $2,800 in Q2. Now in Q3, we have the sales from the actual forecasted transaction. Then we have the decrease to sales related to other value when we marked the option contract to market. And then we have the increase to sale of reclassifying all of our intrinsic value changes from OCI into net income. So if we sum those, we end up with an overall effect on sales of $167,400. Now for the overall effect on cash, in Q2, we see that we spent $3,600 of cash on the option contract. That's the only thing that affects cash. Now in Q3, we receive cash from the customer in an amount translated at $162,000, and we also receive $9,000 of cash on the settlement of the contract. And if we sum those two together, lo and behold, we end up having an overall effect of $167,400 on both sales and cash. Now, one more thing that I want to note before we move on or wrap this up is that we do have some other options under GAAP related to recording other value for options. So in the example we just did, we recorded the other option value, which primarily arises from the time value of money using the entries you see here. And I'm going to just highlight the effects that we had related to the other option value. For both of these, we debited sales for basically just the difference between our intrinsic value and the option fair value change, okay? And that's one way to do it. GAAP allows that. If you notice, if you add those two numbers together, 2,800 plus 800, that gives you 3,600. That is the other value in total recognized over the life of the option, which also happens to be the option premium, because when you buy an option premium, no intrinsic value has happened yet because the spot rate hasn't changed at all. So all of the value of the option at the beginning when you purchase it has to do with the time value of money. What could happen? Who knows? That's why people buy an option, to kind of protect themselves against that. So all 3,600 of that initial purchase price is considered other value. You can either record it proportionately based on intrinsic value like we did here, but GAAP also gives companies the option to amortize it equally into sales. So instead of having one debit of 2,800 and one debit of 800, they say you can just take the full amount, 3,600, and divide it in half and record half each time. So you take the amount of the option premium, you divide it in half, and you debit that to sales in each period. The change on the other side then is that the amount recorded in OCI changes, and doesn't directly tie to the spot rate like it does if you use the other method, but either is allowable under US GAAP.